Hi, today we're diving deep into one of the most essential risk management tools out there, Value at Risk or VaR, focusing more on the parametric approach, discussing why it's popular and its critical limitations, especially when markets turn abnormal and correlations spike. We'll also discuss some practical tips for risk professionals or beginners who want to enter the field, so we suggest you stay until the end for these tips. By the way, I've thought this topic before for my professional seminars targeting institutional clients that have included the Central Bank, the Asian Development Bank, for CFA review programs, and for graduate courses at the university level. And I've also been on the applied side working as a senior officer in a major bank as well, so you should find this useful. But first, if you don't have any background at all in statistics, matrices, and portfolio variance, it's best that you go back first to our statistics crash course, especially lesson 1, and then our videos on matrices, especially lessons 1 and 3, and also our video about the correlation matrix before coming back to this video, because this video will be computation heavy, but still workable. I'll promise to make it fun. First, what is VaR? Well, one can say it's the answer to the question, how bad can things get? Well, yes, that's a simple question, alright, but remember, things can go really bad and you can get totally wiped out. So, maximum risk is essentially not a useful question to ask if you can get wiped out. So, maybe you like to phrase it statistically, like through some sort of average, like 95% of the time, what kind of losses are we talking about? At most, that sort of stuff. Okay, got that. But when can this happen? Okay, this brings us to the idea of time horizons. When can you expect these kinds of losses to happen? So normally we talk about daily losses and how much in number of days can we take on these risks given a particular time horizon until we are able to unwind a position, for example. That's why we want to take a look at these losses. Right, so 1, statistical levels, 2, time horizon. Alright, one more thing. We need to talk about the money losses and not percentage losses. So that becomes very real from the managers all the way to the board level, how much money is at stake. If we do this, then we are basically talking about value at risk. So what is VaR? Well, one way it is normally put is this way. VaR is the maximum expected money loss over a given time period at a given confidence level. For example, you might be holding a portfolio valued at $100,000 with a one-day VaR of $5,000 at 99% confidence. This means there's a 99% chance you could lose at most $5,000 on your portfolio for one day, or alternatively, there's a 1% chance that your losses are at least $5,000, assuming a normal distribution. Notice though that this is not a maximum loss per se, but a loss given normal markets at a given time horizon with a given confidence level. We'll go back to this later. There are 3 ways that value at risk can be estimated. One is by the parametric method, which we will discuss here. 2, the historical method, which does not need any closed form solutions like what we're going to do today. Or 3, via Monte Carlo simulations, a topic we discussed before in this channel. Alright, so the parametric method, also known as the variance-covariance or the delta normal approach, is the most straightforward way to calculate value at risk. Here's how it works. The assumptions. It assumes that asset returns are normally distributed and that the portfolio's returns are a linear combination of its assets. Alright, that was a mouthful, but we discussed portfolio variance before, so kindly revisit that please if you like. And then the inputs. You need the mean and the standard deviation, aka volatility, of the portfolio returns using the covariance matrix and weights, or their correlations. More about this later. Okay, so first we need to talk about computing for the returns and portfolio variance. So essentially, we'll start with computing for returns. And the whole idea here is that we're taking a look at the returns, and then we're taking a look at the standard deviation of those returns, and then we'll take a look at the negative side of the tail. So, returns. If you have daily prices for assets, stocks A, B, and C, then your daily return is simply price now over price previous minus 1. So, you take today's price, divide by yesterday's price, subtract 1, and boom, you have returns. So, we have it here in our old slides, which we are reproducing here. Then, Next is we compute for the portfolio values of the returns and the standard deviations given, let's say, equal share in each stock or 1/3 of your portfolio into each stock. So the portfolio return and variance would look like this. And the spreadsheets, which we are also making available down below. So given the portfolio return is 62.14%. The portfolio variance 0.1362 plus, right? Okay, so we now lined up the portfolio numbers versus the stock returns and standard deviations and see how they compare across each other. And notice this point, and this is huge, that the portfolio variance is not the average of the individual variances, unlike with the portfolio returns. So the portfolio variance here, given 1/3 proportion of your portfolio into each stock, is smaller than the simple average of the variances. This is because it can happen that, let's say, two risky assets can have a variance that is lower than the sum of the variances of the two stocks. This is the effect of diversification, that the portfolio variance shrinks because some risks cancel each other out. It's like selling umbrellas and sun lotion. If it's sunny, you sell the lotion. If it's rainy, you sell the umbrellas. So as a standalone businesses, they are risky. But taken together, you have an all-weather business because the risks offset each other. I hope this gives you an idea of diversification. Now, assuming returns are normally distributed, we can compute value at risk using the mean and standard deviation of returns. So here's what the calculation would look like if you had, for example, a 95% confidence. The z-score is about 1.645. The formula looks like this. Where mu is the mean return, z is z-score for your confidence level, and sigma is the standard deviation of returns. However, note that this is not yet a money loss, but a loss in terms of returns. Therefore, we need to multiply this with the portfolio to get a money loss. Additionally, for daily returns especially, the expected return is not statistically different from 0, and we can drop the return mu, focusing only on the standard deviation. Note that we are talking about the negative returns only, so this is just a one-tail distribution that we're talking about, a question of how much will be the hit on a portfolio. Also, finally, we can take out negative sign because by convention, we are already talking about losses. So voila, here we have the value at risk formula, which is Z times the standard deviation times the portfolio value. In our example, it's just 1.645 times 36.92% times 100,000, so 60,728. Note that the numbers we are using here are greatly exaggerated for effect, but you can get the point. So putting more realistic numbers, say your $100,000 portfolio has a standard deviation of 2% and you want 95% confidence, then the value at risk is equal to 1.645 times 2% times 100,000, which is 3,290. So there's a 5% chance of losing more than 3,290 in one day. Now, I recommend talking about this from the minimum loss point of view, like I discussed it. You see, talking about it by using its statistical equivalent, saying that the loss is a maximum of 3,290 at 95% confidence, can leave an impression that that's the maximum loss. It's not. You can lose everything, remember? Although that happens only 5% of the time. So, saying that the loss is at least 3,290 rather than at most 3,290 makes it clear that the losses can be bigger, but that will only happen 5% of the time during normal periods. Alright, so alternatives of computing value at risk using the correlation matrix. In real life, each asset that you will have its own value at risk already computed. So we should use the individual value at risk and use the correlation matrix instead. First, let's break down the formula and decompose the variance-covariance matrix into the standard deviation matrix S and the correlation matrix C. The formulas and transformations will look like this, where the matrix SCS is nothing more but the variance-covariance matrix omega. So this is what it looked like, where S is the standard deviation matrix, C is the correlation matrix, W is the percentage weight matrix, and the matrix SCS is nothing more but your covariance matrix omega. So this is the portfolio variance, but this time expressed in terms of the correlation matrix. From here on, we're going to drop the percentage weights, but use the money weights instead. So rather than talking about 33%, we're going to talk about $33,000. Now we're going to use the money weights multiplied by Z and call that the new capital W vector, or the W vector, but capital W this time. When you multiply this, the standard deviation matrix, we get the positional VaRs, and this is what it looks like. So first we group together the matrices and vectors. Now note that instead of working on the weights, as we said a while ago, as percentages, we can work with the actual money exposures and multiply them by Z. So that when we can multiply that to the standard deviation, we can actually get the positional VaR. So we're going to use the capital W over here, which will already express not just the weights in monetary values, but includes the Z as well. Or the for a 95% confidence, we're going to use the 1.645, for example. The weight transpose times the standard deviation matrix, I'll call that the V transpose, where V is the value at risk vector. If we have the value at risk vector, which is the VaRs of all your individual positions, then we'll simply multiply V transpose times the correlation times V. Then since we need to get the standard deviation, we need to get the square root of that. And this is what the formula looks like. So using the positional VaRs and the correlation matrix, we can get the portfolio VaR and see the computations here. You'll note that you're going to get the same amount or the same value regardless if you go through the covariance matrix or the correlation matrix. And from here on, this is just what you need to do. It's simple, right? Okay, so why is parametric VaR so popular? Well, it's simplicity. It just looks complicated if you take a look at the matrices, but once you get the hang of it, it's actually quite useful and you can use Excel to actually compute the values. It's transparency. The method is mathematically clean and interpretable. This is especially true for internal auditors or if the regulators wish to inspect your work. They can always double check that, especially if you're the auditor. Scalability. You can quickly adjust for different time horizons or confidence levels. Now, the big limitation, normal markets versus abnormal markets. So here's the catch. Your parametric VaR relies on some big assumptions that only hold in normal markets. So the normal distribution is what's used. It assumes asset returns follow a bell curve with extreme losses being very rare and stable correlations. It assumes correlations between assets are stable and less than 1 and will hold through time, which allows for diversification benefit. But in abnormal markets, think financial crisis or panic sell-offs, these assumptions break down. For example, you're going to have fat tails. Real-world assets have fat tails, meaning extreme losses happen more often than the normal distribution predicts. For example, during the 2008 crisis, markets saw losses that were supposed to be nearly impossible under normal assumptions. Then the correlation breakdown. In a crisis, correlations between assets often surge towards 1. At that point, diversification disappears as everything falls together. Parametric VaR, which counts on diversification, drastically underestimates risk in these moments. So why will VaR fail? Well, it will underestimate the tail risk and the correlation will approach 1. So that whole thing about diversification, it disappears. Well, this simply means that it's not perfect, but it's still a useful number to use. It's a great starting point for understanding portfolio risk, but you always have to remember the limitations. In calm markets, it works well, but when the storm hits and correlation spikes, it'll leave you dangerously exposed. You'll need a different metric for that. Here are some key takeaways. And we're going to wrap it up with some pro tips. One, VaR gives you some sort of average money loss at a given time horizon, where the average is normally expressed with a given alpha, 5% or 1%. But in reality, returns can be fat-tailed, so you might want to use multipliers to whatever you'll have to accommodate the non-normality of actual returns. Number 2, diversification matters, but remember that correlations break down during a crisis where everybody panics and people sell everything, so all prices start going down at the same time. Number 3, parametric VaR is fast and elegant, but stress tests your models beyond simple Gaussian assumptions or normality. And then finally, Excel can do a lot, but for real portfolios, you might want to move to Python, R, or some risk engines when things get hairy. Our computations here are done in Excel for simple pedagogical reasons, but in real life, you'll be working with big data. However, you can also start working on a sandbox using all those software with smaller data and double check your output with Excel and do some sampling and test data. And then when you know it works, then that's the time you deploy fully outside of Excel, which means your Excel skills will still be useful. And like I said a while ago, if you're being audited or you're the auditor, Excel will be very, very handy in double checking the numbers. Okay, so if you found this breakdown useful, smash that like button, subscribe for more deep dives, and tell me in the comments what finance concept should we tackle next. That's all that we have for today. See you next time.